Edward Yardeni, who's joining us on this. He's President, Yardeni Research. Mr. Yardeni, very good morning to you. I hope I'm saying your name correctly. Yes. Great to have you here on NDTV Profit. So, do you think this is a consistent sign that the U.S. economy is truly resilient? Word of the day, actually, this morning in the studio, is truly showing resilience and enough cues for the September rate cut that's being penciled in?
Well, I really don't think a September rate cut is necessary, but the Federal Reserve, especially the Fed chairman, has made it pretty clear that if inflation continues to moderate, as I think it will, they will give us a rate cut in September. The overall economy doesn't really need it. It has been very resilient. I think while the Fed has certainly tightened monetary policy since early 2022, it's also normalized interest rates. And the economy has demonstrated that it is resilient. The consumer continues to spend. Capital spending is very strong. So there's really no need for interest rate cuts. But I think we'll have one, and then it'll be one and done. I think we'll get one in September, and I don't expect one in November and December.
One and done. That's a really interesting kind of a take coming in. And in terms of the consumer push that we're seeing, do you see that also sustaining, Mr. Yardeni? What are the trends that you're noting there from the latest data that has come through?
Well, we do tend to look at the consumer as though everybody's the same, but of course that's not the case. I think low-wage consumers are under pressure. They may very well be maxed out on their credit card debt. They may be under more financial stress. But then you've got the baby boomers. These are people who are retiring now, who were born from 1946 to 1964. We had a baby boom after World War II, and 75 million babies were born. And those babies are now old people. They're seniors. They're like me. And I'm still working for a living, but many of my friends are retiring. And, in the famous show Star Trek, Dr. Spock says, live long and prosper. And a lot of Americans have lived long, and they've accumulated a lot of assets. And as they're retiring, they're spending a lot of the money. So I think that accounts for a lot of the strength of the U.S. consumer.
Edward, hi, it's also Samina joining in. While we take your point that the U.S. economy looks resilient, there may not be a need for more than one rate cut. Right. But debt markets, equity market participants, the Fed futures are indicating that there's a 96% chance that the U.S. will get more than one rate cut. Now, if you don't get that, what happens to risk asset?
Right. Well, as you know, we started out the year with the markets anticipating 6 to 7 rate cuts. I was not in that camp. I couldn't understand why the markets expected so many rate cuts. To me, the economy looked really quite resilient. And as you can see, so far, we haven't had any rate cuts. And the stock market, only July 16th, the S&P 500 made an all-time new record high without any rate cuts. But it is anticipating rate cuts. And I think at this point, the highest probability is that there will be a 25 basis point cut in September. But I don't think that so-called risky assets need to have lower short-term interest rates. The bond yield could just fluctuate around 4.5%, and I think the stock market can go up on earnings on a resilient economy that is profitable.
Edward, very quickly, just on equity markets, because you've read and learned these markets for decades together, do you feel like it's a perfect cocktail, right? Earnings are largely in line with expectations, may potentially get one rate cut, economy looks good as we see it, but the fact remains a correction is much overdue. Do you feel like Indian equity markets, US equity markets, and Japan, because these are the 3 best performing markets in the world, are getting ready for a correction, and that could be a time or a price correction?
They may very well be ready for a correction. There also could be a rotation, particularly in the United States. I think we're seeing profits being taken out of the so-called Magnificent Seven and going into smaller and mid-cap kind of stocks. Because let's face it, lower interest rates do benefit smaller companies more than they benefit large companies who don't depend as much on the credit markets, particularly floating credit. So, yeah, I think a correction is possible, but look, you have to be a genius to get out at the top and get out at the bottom of corrections. And I don't think it's really worth the aggravation. I think if we do get a correction, it'll be a buying opportunity.
All right, thank you so much, Edward Yardeni, there with the, and I think the big takeaway from what he's saying about the Q2 US GDP is that it's indicating that one and done is something that the economy could really pallet. But will it be that or not? We'll have to wait and see, of course. Thank you so much, Edward.